Hey, Dustin Tibbitts here, financial advisor with Jazz Wealth Managers. How you doing this evening? We are continuing, we're just kind of finishing up with the bear face there. That is that Canadian whiskey. I'll tell you what I've learned, just, I don't know, like a quarter of the bottle. Put an ice cube in there, right? And then it really like brings out this honey caramel kind of a flavor that I didn't notice before. So a little tip for you guys if you like the bear face from Canada. All right. Tips for long-term investing. We are long-term investors here at Jazz Wealth, and so we build our own portfolios. We do not get emotional about the backs and forths of the market, but it's mainly because of the data that we use rather than me or one of us here getting super excited and just changing positions. We don't do that. So let's have some fun with some of the data here, see what we can learn. You ready? We're going to talk about the power of long-term investing. Just for fun. I know nobody would do it. Just hang with me. I know nobody would do this. If you invested $1 the day the stock market opened, that dollar would be worth $28,916. After inflation, whatever. If you invested $100, that should say 1871. It'd be worth $2.8 million. If you invested $100 in 2000, it'd be worth about $300 after inflation. There were 19 crashes. Really crashes here over the market's history, and let's take a look at a few of them. You're going to know some of them from studies in school or just living through them. Great Depression, we lost 79%. Of course, that was 1929. People literally jumped out of buildings or committed suicide because it was that bad. It was a big drop, though, by the way. The Lost Decade, this is part of the reason why your $100 is only worth $300 if you started investing in 2000 and didn't add anything else to it. So down 54%. Watergate, anybody remember that? Made a few good movies out of that. I would agree. Down 51% there. COVID, we lost right at 20%. Intraday, we actually lost a lot more, but this is close to close. So if you're going to pick on the data a little bit, just know that that's how I'm coming up with it. Took us 4 months to recover. And the inflation issue, remember when inflation was like a huge deal and everybody was like, I'm going to go buy those bonds that pay for the I bonds and I'm going to get 9%. No, I told all of our clients, come on. Anyways, took 18 months to recover. Here's the thing that we learned from this. COVID, 4 months to recover from the February high. Remember that March low. To recover from that was 4 official months. Inflation, 18 months. Great Depression, 4.5 years. And the Lost Decade, of course, 12 years. It was like 12 and a half years in there. So market crashes are very common, right? We know that on record, there are 19 of them. The recovery time, we can't really make any interesting discussions there, right? Like we're not going to figure something out. So we've got to learn how to kind of play inside of that. Now, Morningstar, I think they still have it. They do something called a pain index, and they look at the pullback relative to the recovery time. They made an index out of it, and it assigns it essentially a percentage of how painful various pullbacks were. The Great Depression is, unfortunately, the benchmark that they use for this, 100% pain threshold there. And the Lost Decade, 47%. And COVID ranks as the least painful crash because we only fell technically 20% on the way down, and we recovered so fast that it really wasn't painful for that long, actually. Now, what if you're investing during those time periods, right? You're going to live through another crash. Like everybody watching, we're going to survive another crash. What if our balance was here? What do we have to watch it do, assuming a normal market level investment? $100 during the Great Depression turned into $21. I don't know that I would have lived through that. That would be pretty painful. $100 during the financial crisis, the bank's going under there, $46. That was also on the way down, somewhat short-lived. The recovery took time, of course. And then during Watergate, $100 turned into $48. The thing to note here is every single one of these officially recovered. We have a box of towels, and I bought them. We made them for clients. They're little workout towels that says the markets recover 100% of all declines 100% of the time, because that is still true. 100% of every pullback in the market has recovered 100% of the time. It's the only thing that I'm aware of that we can say 100% of the time the returns will be positive. Over time, of course. So we've got to learn that market pullbacks, market crashes, the real nasty ones, unfortunately, it's part of the game. Thankfully, they only happen about once every decade. So we just kind of, had the COVID thing, right? So maybe you say, we're good for a while. I don't know. And note that markets always recover. The long-term investor is always rewarded for sucking it out or sticking it out, right? Sucking it up, sticking it out, whatever you want to say there. I'm not saying day traders, swing traders, you guys, you got to get in there and fight for what you want to fight for. Long-term investors always benefit from this. Now, the beginning of the year so far, we're down about 3.5% there. President's tariffs policies and, of course, adjustments to that, price adjustments to that, still have most analysts saying we're going to finish positive. It's kind of an easy thing to say, right? They're projecting earnings based on tariff adjustments and going, well, it's still positive, and so therefore stocks should end up higher, at least as stocks in the S&P. So they're projecting 14% upside. I don't know about that because remember, 2023 and 2024, we had back-to-back years of 20% plus 20% gains. We have never had back-to-back-to-back years of plus 20% gains. Doesn't mean we can't be positive. It's just that level of growth is likely not going to continue. It would be a record if we did. So what if we just had like a 5% gain? That's fine, right? We just had a monster run, so it'd be okay if, excuse me, if that's what ends up happening. Now, don't fall for this last one here. Active ETFs. Think about like specialty ETFs, not like the S&P or the NASDAQ ETF. Specialty ETFs that are tech-driven or maybe biotech or growth stocks or whatever it is. Careful with those. Those get a lot of attention when the stock market is a bit volatile and especially pulls back. Value ETFs also get a lot of attention, value mutual funds and things. Remember that at the end of the day, this is a blip. Warren Buffett just said it the other day that what's happened in the last couple of months is essentially nothing, right? I don't know that I would say it was nothing. I think it was an opportunity, but he's like, hey, basically, like it's just a blip in the road, like whatever. And he would know. He's been around. So during this process, when these things happen, these crashes and massive pullbacks, remember to stay diversified. You should already be diversified. And I hate that answer when advisors go, they're on TV and they're like, well, a nice, normal, diversified portfolio. Number one, what the hell is that? Right? Tell me what that is. And number two, why? Like, what if my investment goals require that I take less risk than a diversified portfolio? Maybe I could be more diverse in bonds, more diverse in money market funds. Maybe I'm filthy rich and I don't need to take any risk. So everybody's uniquely different there. So when you see maintain a diversified portfolio, growth, value, bonds, money market, CD, whatever it is that you're into, make sure it fits your plan first, not what the general public tells you. That's like your savings rate. You ever see, Dave Ramsey, right? A great example. Has a double-digit savings rate. And he's like, all right, you got to be 10, 12, 15%, right? Depends on the day with him. But so he'll say these things. There's nothing wrong with that. Like as a general, like, hey, he's got millions of people following him. Yeah, he should probably say something like that. But we have clients that have a 4% savings rate, 9.2 actually. It was just they're actually coming to visit us in the office. They don't need to save anymore. Well, that's a product of people getting into the nitty-gritty of their plans. Considering tactical overweight positions, we just did this in our portfolios when the markets fell apart there. We actually went a little overweight in some of the stuff that historically rallies faster than the market. And that actually paid off really well. So thankful for that. So you can do that. That's not market timing, right? That's just overweight positions in the portfolio that statistically and historically behave a little bit better on the way up. Doesn't mean we would have been right. Just, you get what I'm saying. Also focus on the long term and avoid trying to panic on these downturns. The reason that we panic is we're watching TV. I do it. I watch TV and I'm like, oh my God, I'm going to get some disease, right? It's normal. It's probably not going to happen. But when we look at the stock market and we see all these headlines, well, take a second and realize that that's just what they're focused on right now and try not to panic through those downturns. So 150 years of investing advice right there inside of one video. Hope you enjoyed it. I'm enjoying putting these little presentations together for you guys. If it helps you, of course, maybe you'll hit the subscribe button. If your advisor is not doing this or you're like, I don't know if I should have an advisor, schedule a call with us. We have no sales pitch. We promise we'll just talk with you for a little bit and see what the best fit for you is. Otherwise, you can go to our website. Look right on the homepage there. Everything about us, including our fees and everything, totally listed. We are not ashamed of it, and we're not trying to make you guess. Like, let's make this easy, guys. Like, come on. All right. Enjoy. Thank you.